Hi, I'm here in Singapore. I'm with my good friend Ewan Puckle Hobbs, who I've worked with for a number of years now on a number of these financial systems environments, customer interactive environments. I thought it might be good to sit down and chat with him for just a minute on a conversation with Kit. Thanks for joining me.
It's a great pleasure. Always a pleasure to see you, and especially here in Singapore.
Could you, can you kind of give a little bit of background, Ewan, as to why I might want to chat with you? Tell these people what you've done in this space and what makes your life interesting or professionally anyway.
So for me, I guess the core of my life for the last 20 years has been transforming organizations, many of whom didn't really want to be transformed or said that they did, but actually when it came to it weren't entirely sure that it was what they wanted to have happening to them. For me, the whole question of measurement of a transformation has always been incredibly interesting, and actually trying to get to the roots in a digital world of what is the differential in cost to serve and cost to sell across the different channel types, and how do we understand which customers have potential, which customers don't have potential, and adjust our cost to serve and cost to sell to fit with those people.
That's very good. So I want you to do one thing. Can you define channel? Some of our viewers may not know what channel means.
Okay, so when I talk to bankers, normally they talk about their branch as a channel, and I always take pains to say to them, the branch is not a channel, the branch is a place. It may be a measurement wrapper, and it has a number of channels within it, and these will be places where individual customers go to be served or go to be supported. And many of those channels exist just in the branch. Quite a few of them nowadays also exist outside the branch. So if I choose to put a telephone into the branch and give people access to the call center from there, that service point becomes a channel. If I give them access to my web banking within the branch, that would be a channel in its own right. And then the more traditional lobby manager or teller would also be channels in my interpretation.
Yeah, so any of those service points, service interaction points where you satisfy a customer need in some way. So where Ewan taught me a number of things as we worked together on, particularly on a bank in Mexico, one of our first engagements together, it was around this measurement idea and getting to measurements that affect how people behave and helping to make that measurement process to drive behaviors in the right way. Is that a good summary?
Absolutely.
So kind of talk about that. What does that mean? How do you try to do that and why?
Well, and this started for me very early with a bank that I worked with in Turkey in the late 90s. And we knew that we were going to need to be able to differentiate between, for example, customers who came in for service in their home branch and went for service to a branch that was perhaps closer to where they worked instead of closer than where they lived at other times. We wanted the customer and the profitability of the relationship with the customer to be owned within the home branch. But we also wanted to be able to credit branches that were providing service and other channels outside the branches that were providing service with the cost of what they were doing for the customer, so that we could either have a cost center for external channels, or we could make sure that branches were correctly credited for money that they were spending servicing customers whose profit was accruing in a different branch.
Yeah, so you'd certainly want to incent branches to serve customers even though they don't own them.
Yep.
That's an enterprise goal, to make sure that you give that sort of thing. But you want to make sure that the home branch who owns that customer, nurtures that customer relationship, is incented to make sure that customer is satisfied and is incented to own that customer relationship in an appropriate way.
Yeah, and we also had to make sure that the branches that they were visiting on occasions weren't trying to steal them from their home branch.
Yeah.
And all of those behaviours were going on because when we started, each of the branches was very strongly incented to grab any customer that they could get hold of. And there was no penalty for trying to persuade a customer to move branches if I thought that it might bring me profit or sales.
Yeah. So one place that we went, though, is that, as I've talked about in other videos, that we measure revenue by customer because customers pay us things, so that's where revenue comes from. But one of the problems is that costs are not accrued by customers because you pay employees, you pay vendors, you pay other people, and so there's not a direct relationship between customer activities and the cost that it takes to service a customer.
Mm-hmm.
So where does that fit into this whole equation?
Well, progressively, and as the range and variety of channels, both inside the branch and outside the branch, increases, we need to be able to work out the cost to serve and cost to sell in each one and accrue those almost at an individual customer level to get a view of the profitability of that customer.
Yeah.
And if we can do that, then actually we can begin to build profit models which support a channel view or a product view or a view for a customer or a customer segment or a specific target group for a campaign or whatever. And the only way that we can really do that is to attribute cost at a transactional level. So we need to be able to look at the customer, see what transactions they're doing, and then when we look at the whole set of transactions within a particular channel, we need to be able to allocate that cost across all of the customers who used it. And we really need to be able to do that on a real-time basis so that we can get a view of actually which channels are operating effectively, which channels are operating ineffectively, and then which products are we selling and servicing effectively, and which products we're beginning to lose money on. Because if we're losing money systemically by serving the wrong groups of customers in the wrong channel, that will ultimately impact the overall profitability of the bank.
Yeah. So if you think, just to take that example, you simplify it for people. If you think about the cost of the ATM machines, right? You pay vendors for ATM servicing and the cost of those machines, and yet you know how many customer transactions happen at ATM machines. So you have a count that you can attribute directly to a customer, their number of transactions. You have to get to a per unit cost for the number of transactions across the ATM network. That allows you to start to assign directly attributable costs to customers. Customers who use ATMs as opposed to tellers are going to cost you less money, and that should be reflected in the services you can offer customers because they're costing you less. It should be, you can match the cost better to the revenues involved.
And the other side of that, of course, is the ATM is the automated teller machine. If people don't like using the automated teller machine and want to go into the branch and do all of their transactions at a manned teller, that's one of the most expensive service points that we have in the bank. If this is a not particularly profitable customer and they continuously and systematically use the manned teller, then they become a source of significant cost for the bank.
So I think I'm going to show a slide, Ewan, that I stole from one of your presentations that I just showed a few minutes ago. And the slide, I think, was very interesting to me because Ewan taught me that you can segment your customer base by the cost to satisfy customers. So if we look at, this is profitability on the slide, and if you look at the 15% of the customers in this one study done, cumulative profit over time, 15% of the customers generated 100% of the profit for a particular bank. Mm-hmm. Then there was another 50% of the customers that only added another 10% of the profit on top of that. Then there was a bottom, I think it was 10%?
30%.
30% of the customers that had a very high transaction costs. These are the people that are only working at the teller machines, and they're paying perhaps ATM rates for working directly with tellers.
Yep.
And so they actually end up decreasing profitability over time. Is that why? How does a company manage through that process if they know these customers? How do they use that information effectively?
So the core demographic that is shown in the chart is actually pretty standard for retail banks all over the world. And I've been carrying that chart, which was first created for my friends in Turkey in 1998. It represents every single customer in the retail bank, in that case, starting with the most valuable customer on the bottom left and ending with the least valuable customer on the top right. And it shows the cumulative profitability. And then the lilac-coloured line further down shows the cumulative transaction. And as you say, the closer we get to the far end, we see very steep transaction curves. So there are guys here who are dealing with the bank, but are cunning at getting their transactions at a very low cost. Once we can understand that and understand the dynamics of those customers, then we can begin to take action to change the way in which we deal with them or serve with them. If they have a low profit potential, and that's exactly what we see in that middle 50% that you talked about, typically those will be mass customers. And for mass customers, we need to have a very low cost to serve.
Yep.
We need to have very simple products. Poorer people don't really respond to the sort of buy one, get one free idea unless they have a large family to feed. So people who don't have an immediate financial need are not going to buy a bundle of products for a discounted price. They want the individual things that they want at a very low cost. On the left side, we're seeing the more affluent customers going down to the extreme of very wealthy private banking customers. Those people do need relationship support. Typically, they're time poor and they're quite good at using low-cost channels. All of that helps the relationship, helps the cost of the relationship, but it makes actual relationship management more difficult because if they're always interacting with the bank in remote channels on the web or on their mobile, then it becomes very difficult to have a direct conversation with them. And so the challenge in those segments is how do we make the bank really cost effective, really efficient and easy to use.
And relevant in their lives.
Relevant in their lives,
Yeah,
and how do we grab their attention or get them to feel confident enough to grab the bank's attention when they really need advice or when
Yes.
they have a particular set of financial circumstances that requires discussion.
Yes, that makes sense.
And then at the other end, and clearly there are always going to be some customers who either because they don't want to pay or because they cannot pay are going to end up in distressed debt, and the bank will lose money on those. But the rate of losing money is actually probably less significant than the ones who are just clever at getting a lot of service for less money. And one of the things that we found as we went through this cycle, on the back of the whale chart that you've shown, we started to implement a real-time profit system for this bank. And they now use that as the basis of their channel management and incentive structure. So every individual in the bank is able to see precisely how much profit their activities are contributing both to their branch, to the channel they work for, to the product that they represent, and ultimately to the overall profitability of the bank.
That's interesting. And you just took me to, it may be interesting to see if the customers even understood their relationship on this graph. It may be useful to them to understand how the bank serves them effectively and what they do because a relationship is a two-way street.
That's a really important aspect of it, because if a customer belongs to a segment which will never be profitable, and the bank needs therefore to manage the way in which they're served, being quite upfront about the commercial realities is actually a much more honest process than just treating them nastily.
Yes.
And my experience is that where banks communicate clearly the reason that they're doing things, that actually helps the customer to understand. And a lot of banks now are quite good at setting up cost structures which give customers choice.
Yes.
So the customer can choose to come to the man teller, but they know that if they come maybe more than twice a month, they will pay extra for that level of service. While if they use the ATM or they use their mobile or web, they won't pay that level of charges, and that seems to be a win-win.
That's interesting. So you can see why I found this conversations with you, and it's taking much of the measurement that I've talked about in so much of these systems and putting it right there to the end of where we need to go to make our organization stronger and our customer interactions more effective.
Good.
Thank you.
Thanks,
I appreciate your time. It's very effective.
Good.